Yesterday, the markets didn't just dip, they detonated. A full-blown, cross-market meltdown that erased billions in hours and left traders speechless. Over $19 billion in leveraged crypto positions were liquidated within 24 hours, the largest single-day liquidation in history. Bitcoin, Ethereum, altcoins, stocks, bonds, even commodities, everything fell in perfect sync. The trigger? A policy bomb from Washington. President Trump announced 100% tariffs on Chinese tech imports, effectively reigniting a full-scale trade war with the world's second-largest economy. This wasn't just about trade. It was a declaration that global supply chains, semiconductor production, and even the AI boom are now geopolitical weapons. The reaction was instant. Tech stocks, Nvidia, AMD, TSMC all plunged. The S&P 500 crashed 2.7%. The Nasdaq dropped 3.6%, and global indices turned red within minutes. But while stocks bled, crypto collapsed. Bitcoin nosedived over 8%, Ethereum tumbled more than 12%, and the entire market cap of crypto shrank from $4.3 trillion to $3.7 trillion in a matter of hours. More than 1.6 million traders were wiped out. Leverage was the gasoline, and panic was the spark. Platforms like Binance and Bybit were clearing long positions every second, triggering a chain reaction of forced liquidations that dragged prices even lower. It wasn't fear alone, it was mechanics. When one trader's position gets liquidated, it forces the exchange to sell into a falling market, pushing prices down and causing the next trader's liquidation, and the next and the next. It's a self-feeding monster, one that thrives on greed and leverage. And this time, that monster devoured billions. But this bloodbath wasn't contained to crypto. Traditional markets got slammed too. Bonds rallied, volatility spiked, and money flooded into safe havens like gold and the US dollar. It was the classic risk-off rotation, when traders collectively say, "Get me out of risk now." The irony? Gold barely moved compared to the chaos elsewhere, because even safe havens were being sold to cover margin calls. The contagion was total. Global investors were watching US policy uncertainty, Chinese retaliation fears, and an already fragile macro backdrop where inflation is sticky, oil prices are climbing, and central banks are running out of room to maneuver. The Federal Reserve, already cautious about inflation, now faces a nightmare scenario. Tariffs drive up import costs, inflation ticks higher, but markets are collapsing. Raise rates and they risk breaking things again. Cut rates and inflation could reignite. Every move now is a trap, and traders know it. That's why volatility exploded. Not just because of what happened, but because nobody knows what happens next. Meanwhile, inside the crypto world, this event exposed the brutal truth about overleverage. Retail traders chasing breakout dreams with 50x leverage were erased in seconds. Bitcoin's flash crash wiped out billions of paper profits, leaving only those who had proper risk management still standing. Ethereum, Solana, and altcoins followed like dominoes, each drop triggering another round of forced selling. But if you zoom out, this kind of purge is not new. It's part of the crypto cycle, the cleansing event that flushes out weak hands and resets funding rates. Historically, massive liquidation events like this are followed by volatile accumulation periods. It's where big money enters quietly while retail hides in fear. The charts may look like disaster, but smart traders see opportunity. Liquidity gaps, imbalances, swing failures, fair value gaps, all freshly printed setups waiting for confirmation. Once the storm passes, these same zones will define the next leg up. What caused such an explosive reaction wasn't just news. It was the combination of geopolitics plus positioning plus leverage. The tariffs shocked sentiment. Algorithms detected momentum, and leveraged positions amplified the fall. A perfect storm. Institutional traders were already hedged. It's always retail that takes the hit. And this is the core lesson. Markets don't crash because of bad news. They crash because of bad positioning. Everyone was long, overconfident, and exposed. The market needed balance, and it got it violently. If you look at heat maps, crypto, or equities, they were bathed in red. Stocks, especially tech, lost hundreds of billions in market cap overnight. Even Apple and Microsoft, usually defensive, saw heavy sell pressure. On the other side, bond yields dipped, signaling a flight to safety. The US dollar index spiked. Oil had a volatile session. In short, it was a synchronized de-risking across every asset class. So what now? Traders should not chase the bounce. The first rule after a liquidation event is to wait. Let the charts rebuild structure. Let liquidity form again. Once you see break and retests, Once price reclaims key EMAs or structures, that's when momentum returns. Watch for swing failure patterns, false breakdowns that trap shorts before reversals. Study fair value gaps created during the crash. They often get refilled before continuation. Monitor funding rates. When they flip negative, it's a sign that fear has peaked. And most importantly, track macro headlines, tariff negotiations, Fed commentary, inflation reports, because right now fundamentals are driving everything.